Welcome back. Now we're going to talk about some factors that influence interest rates. So some exogenous factors that actually influence interest rates, I suppose I should say. Now, the first factor that we need to talk about that influences interest rates is Federal Reserve policy, aka monetary policy. Now, monetary policy in the United States is usually covered in a macroeconomics course, but we're going to cover it today because it has a huge bearing on bond prices as well as stock prices. So let's talk about how the Federal Reserve actually influences interest rates. So there's actually three ways that the Federal Reserve will actually influence interest rates. So first, the Federal Reserve might use an adjustment to the reserve requirement. Second, it might adjust, let's say, the discount rate. But usually the way that the Federal Reserve will adjust interest rates is by using what's called open market operations. Now, these open market operations are operations where the Federal Reserve buys and sells issuances of U.S. T-bonds, U.S. T-bills, etc. Basically, government-issued debt. Now, there's some pretty definite relationships between the buying and selling of this debt and interest rates. So I have them listed up here. So if the Federal Reserve wants to buy bonds and increase the money supply, that's going to lead to a decrease in the interest rates in the overall economy. However, if the Federal Reserve wants to sell the bonds that it has and increase the money supply, then that's going to increase interest rates. Now, let's see exactly how this works. And so what I'm going to do is I'm going to flip over to pen and paper, or rather Sharpie and paper, and walk you through this. All right, so here we have a graphical representation of the supply and demand for money. And we're just going to call it money. You can think of it as cash, but we might just say money in the overall U.S. economy. Now, I have here the demand for money. That's just the demand for current cash in the economy. And what I'm going to do is I'm going to draw a line, just a vertical line, that indicates the supply of money in the overall economy. As you probably covered in your macroeconomics class, the supply of money is usually represented by this vertical line. Now, the Federal Reserve, the way that it influences interest rates is by adjusting the money supply. And it can do this in one of two ways. It can either buy bonds in the overall economy, so in this case it would be buying U.S. T-bills, or it could sell U.S. T-bills. So let's say we have a case where the Fed buys a significant amount of U.S. T-bills. In this case, when the Fed buys a large amount of U.S. T-bills, what it's doing is it's buying those T-bills from investors that have already owned them. Let's say these could be commercial banks or even mutual funds or investment banks, what have you. A lot of institutional investors hold U.S. Treasury bills. Now, when the Federal Reserve buys these bonds from investors, those investors are given cash. And that means that they have the opportunity to do a couple of things. Of course, they could spend it on, let's say, a new car or a new office building or what have you. But a lot of investors are going to pump that cash into some new investment, say stocks or bonds or what have you. Now, that increased amount of money that is being pumped back into, say, other stocks or other bonds, that additional capital is going to drive down the interest rate in the overall economy. And the reason for this is that you have more investors bidding on the interest rate that they'd be willing to accept when they buy a bond. So you have, let's say, more investors bidding on, let's say, a 1-year bond of Apple's debt. So in this case, you have a few more investors who are willing to buy that debt. And what we typically see is that interest rate on that debt will typically come down. The reason for this is that there's more demand for that debt. And so the effect that this has on the overall economy, the effect that the buying of bonds, of U.S. Treasury debt by the U.S. Federal Reserve has on the overall economy is that it decreases interest rates. So if we have a starting interest rate of R0, the increase in the money supply is going to drive down the interest rates in the overall economy. Now, the exact opposite is going to happen if the Federal Reserve begins selling bonds. So we'll just do this again. So we have the demand for money here, and we have the quantity of money listed on our x-axis, and we have our interest rates on the y-axis. Now, we'll go back to putting this vertical line indicating the money supply here. And let's say that the Federal Reserve decides that it wants to sell a bunch of U.S. T-bills that it owns. Well, in this case, investors are going to buy those T-bills, and that's going to crowd out the demand for other assets, other bonds in the overall economy. So in other words, this is going to decrease the number of investors that might be willing to buy bonds of Apple or shares of stock or what have you. Essentially, what that means is that the interest rate that the remaining investors who have not bought T-bills is going to be able to, are going to be able to demand is going to increase. So it's going to go from, we'll say R0 all the way up to R1. So in this case, when the Federal Reserve sells its bonds back to the investing public, that's going to increase interest rates. So that's typically how the Federal Reserve uses open market operations to influence interest rates. All right, now let's talk about how federal deficits affect interest rates. So you probably know what a deficit is already, but a deficit is really just when the government or any government spends more than it takes in. So let's say a government spends $4 billion, or let's say $4 trillion. We'll say this is the U.S. federal government spends $4 trillion, and it only takes in $2 trillion in tax revenue, in tariffs, in other forms of income. In this case, when we have such a large deficit, what this is going to do is it's going to require the U.S. federal government to borrow money in order to close that gap. So the federal government typically is going to pay for things like Social Security, Medicare, anything else that the federal government might spend money on, so national defense, etc. So in order to pay for that, the U.S. federal government is going to have to borrow. When it borrows, this is going to adjust our demand for overall interest rates, our demand for money. So let's take a look at how this works by going back to a graph on pen and paper. All right, so we've gone back to the supply and the demand for money or cash in the overall economy. Now, when we have a government deficit, and let's say the U.S. federal government, let's say it runs a $500 billion deficit this year. That means that the federal government is going to have to borrow $500 billion. Well, what that's going to do is it's going to increase the demand for money. When there's an increased demand for money immediately, what we're going to see is that interest rates are going to increase. And so that's more or less how the increase or a federal deficit increases interest rates. All right, let's talk about another method or another factor that impacts interest rates, foreign trade deficits. Now, foreign trade deficits are typically deficits that occur when a country imports more than it exports. In other words, we have this gap between the value of the goods and services that are being imported relative to the goods and services that are being exported. Now, typically, when a country buys or pays for more goods that it brings in than it's sending out, typically what this means is that a lot of individuals or companies are having to borrow to fund those imports. So the way we typically represent the effect that foreign trade deficits have on the overall economy and overall interest rates is by showing, again, a graph like this. So we're back to our supply and demand, and we have our quantity of money on the x-axis, and we have our interest rates on the y-axis. Now, if there's a huge demand for current cash, let's say that everyone wants to import some new product from South Korea. Let's call it the Samsung Galaxy 10. If everyone wants to buy this South Korean product and businesses are trying to raise cash in order to buy that product and ship it back to the United States, what this is going to do is it's going to increase the demand for cash immediately. So we're going to see this shift outward in the demand for money today from the demand for money previously, and we're going to see that interest rates as a result are going to increase. So this is more or less how foreign trade deficits influence interest rates. There's more demand for imports, and in order to finance those imports, companies are borrowing, and we see an increase in interest rates. All right, now let's talk about how business activity affects interest rates. And the way business activity affects interest rates is not quite as linear as some of those other methods or factors influencing interest rates that I just showed you. So the way business activity is going to influence interest rates is, we'll say it's not, well, I guess I've already said it, it's not linear. Now, during periods where inflation is high, aka there's a lot of business activity in the overall economy. Let's say everyone wants to, let's say everyone has more money in their pockets. What this means is that they're going to have likely the opportunity to go out and consume more and more of the assets that they want to buy. Because of this increased demand in goods and services in the overall economy, what we're going to see is that business owners can start to charge higher and higher prices. So what this means is that increased business activity typically leads to higher inflation, or a larger amount of inflation in the overall economy. Now, because this inflation is increasing, this means that the interest rates that investors are going to have to demand in order to receive the same real interest rate is going to have to be higher. I mean, if inflation is 5% or over the life of a bond, and you as an investor demand a 3% real rate of return, you're going to have to demand about an 8% interest rate in order to break even or earn that 3% real rate of return that you really desire. Now, during recessions, the demand for current income for money actually decreases. Now, during a recession, you have less economic activity. You have less business activity. Investors have, well, let's talk about consumers. Consumers have less money in their pockets. I mean, there's greater unemployment. Chances are people might have had to take a pay cut in order to retain their jobs. So they're buying less of they're buying fewer discretionary goods. Let's say, a new speedboat or a new second refrigerator for the garage or something like that. Now, because they have less money in their pockets and they're buying less, in this case, there's less pressure on the price of goods. In other words, there's no real reason for a producer of, let's say, speedboats to increase their prices. There's not that demand already there. So what we see is typically lower inflation in the overall economy when business conditions are poorer. And as a result, typically interest rates are a bit lower. Now, that's more or less how business activity affects interest rates. All right, finally, let's talk about how interest rates, or the impact that interest rates have on stock prices in particular. Over the course of this lecture and the previous lectures, we've mostly focused on the impact of interest rates on bond prices, but interest rates do have a pretty significant impact on stock prices as well. First off, when interest rates are high, typically that's going to affect the bottom line of any company that has to borrow money. So let's say that you are a business owner who has received a loan from your commercial bank in order to pay for a warehouse that you store your raw materials before you produce them and sell them to whoever you're going to sell them to. In this case, you have to pay, chances are, well, you're probably going to have to pay a regular coupon payment to whoever issued you that bond. So forget your commercial bank. Let's say that you issued bonds in order to finance this the building of this warehouse, and every 6 months you might have to make a coupon payment to your bondholders. In this case, if interest rates are higher and you have an adjustable, let's say you've issued adjustable rate bonds, in this case, as interest rates increase, the amount that you're going to have to pay to your bondholders is going to be increasing, which means that the amount of your sales revenue that you're going to be paying to your bondholders is going to be increasing. Now, the reason I mention this is because this is going to decrease your profit margin, or the amount that you have on your bottom line. Now, obviously, the higher this interest rate is, the lower your profit, the less you can offer your shareholders. In other words, let's say you have decided to issue a dividend. Well, if you have a lower, let's say, less profit as a result of higher interest rates, that's less profit that you can use to issue a dividend to your shareholders. As a result, the value of that stock is going to decrease. We'll talk about that in a lot more detail later on, but I suppose we could leave it at that. Now, there is one other reason why the value of a stock is going to decrease as a result of higher interest rates. And the reason for that is not necessarily because the future cash flows you can earn as a stockholder are going to decrease, but rather it's because the discount rate that you're using is going to increase. So what I have up here in this formula is essentially a modified version of our time value of money equation. It says that the value of any asset is equal to the value of the discounted cash flows that you can earn by owning that asset. So CF1 is our cash flow in year 1, CF2 is our cash flow in year 2, and so on and so forth. The way we discount these cash flows back to the present is by dividing, in this case, cash flow 1, by 1 plus our discount rate. We'll call this our interest rate for 1 year. Now, the higher the interest rate is, the greater that you're having to discount this cash flow back to the present. Now, if interest rates increase, the discount rate that you're discounting these cash flows by is going to increase. And so this cash flow, when discounted back to the present, is going to be worth less to you. So interest rates have really two effects on the value of a stock. They're going to likely decrease the cash flows that you would receive in the future, and they're also going to increase the discount rate, or the rate at which you need to discount your future cash flows. And both of these are going to decrease the value of your asset. So that's all I have. Thank you.